Today's session focus on one of the most critical aspect of the energy industry, decision making based on project economics. In this webinar, we will gain insights into real world investment decision making concepts like rate of return and present value trade-off involvement in energy project, practical approaches used by industry professionals. Now, it's my great pleasure to introduce our distinguished speaker for today's session. We are honored to have with us Mr. Steven Jansen, Vice President Upstream Energy Investment at Kayne Anderson Capital Advisors. Mr. Jansen brings extensive experience in energy investment analysis, project evaluations, and asset valuation, strategic decision making in upstream oil and gas. His expertise in bridging finance and energy engineering makes him the perfect speaker for today's topic. With this, I'd now like to invite Mr. Stephen Jensen to deliver his talk. Sir, we are truly honored to have you with us today. The stage is yours. Now you can start, sir.
Thank you very much for that introduction. It is a privilege to speak with you all this afternoon and evening. Thank you to the IITG SPE student chapter for hosting this talk, and look forward to speaking with you all. As mentioned, my name is Steven Jansen. I'm a vice president at Kayne Anderson Capital Advisors. Been here for about 3 years in upstream energy investments with specific focus on the technical diligence aspect of the deals that we're looking at in the upstream private equity space. My career spans from operations at ExxonMobil, where I was an asset level engineer looking at specific drill wells and workovers, very, very focused on the ground and close to the asset. Moving on to Netherlands Sewell and Associates, where I spent 12 years in the consulting space, really taking a step back from there, working with a variety of different companies, both publics and privates, evaluating their assets at more of an asset and company level. And then finally, with my transition to Kayne Anderson, taking a step back even further and looking at broader corporate structures and, really from the building blocks of making companies, bigger and better over time. So with that perspective, I'm hoping to, communicate a few topics that might be helpful for you all as early career professionals or students as you're approaching your careers and working to make your own decision making and economics investigations throughout your career. Briefly here, I want to touch on the oil and gas value chain. Obviously, oil and gas spans the upstream space with exploration, production, and development. The midstream space, where it gets those volumes and production volumes to market via gathering, transportation, and processing. And then, of course, the downstream space with refining, distribution, and marketing. Obviously, with my expertise, I've primarily focused on the upstream space, but the principles that we'll be talking about today really realistically apply across the entire value chain. I think what's unique about the upstream space is that as petroleum engineers, we can bring very unique insights into the uncertainty that exists in upstream investments, because upstream is really where the uncertainty is most visible, right? The volumes are beneath the surface of the earth, right? We're doing our best to quantify those volumes, determine how much is economically producible, and ultimately what the cash flows from that production look like, and translate that into models that can be used to make real-time decisions in oil and gas investment. So what does justify making a project economically viable? I guess I want to start by saying that not every project that's economic is an investable project. And I think what that means is projects ultimately have to compete for funding because capital is limited. It's constrained by your fundraising efforts. It's constrained by the capital recirculating within the business. And you have to make discrete investment decisions to make sure that capital is allocated in the most prudent manner to support stakeholders and shareholders in the business. Just to take a look at this landscape here, I'll point out that we have an offshore project in Project B that returns a 22% rate of return, and an onshore project in project C that returns an 18% rate of return. And other things equal, you might say, well, project B is the higher rate of return. Let's invest $30 million in that to get a 22% return on our money. But I would point out that there's much more beneath the surface than just the statistics listed on the page here. Project B might contain much more risk on the execution side, but then also on the uncertainty with the reservoir accumulations themselves. Project C might be a little less risky in that it's onshore, unconventional, much more statistically driven outcomes. Project C might also be distributed across, let's say, 5 wells on a pad for $25 million versus a single well offshore for $30 million. So these are the considerations that need to be baked into your analysis to say, just because a project is a 22% rate of return doesn't mean I need to allocate value and capital to that project because that 22% rate of return might just carry much more risk than the 18% project. And I think using that as a springboard to spend some time on risk and uncertainty, I alluded to this earlier in the conversation, but petroleum economics really is built on interpretation. Obviously, there's interpretation that goes into the subsurface geology, the reservoir properties and fluid properties themselves, how that translates to well performance and ultimately the corresponding cash flows from a development well or a set of wells in a project. And then, of course, you have the commodity prices, which swing and ebb and flow as the commodity cycles tend to do, and OPEX costs that might vary as well as services change in price to align with the current price environment. So as petroleum engineers, we're uniquely equipped to be able to add some unique interpretation and insight into the range of potential outcomes that ultimately transform into a business decision. We think of things in terms of a probabilistic outcome, and as a result, we can generally hone around a base case that could be considered a most likely outcome. But I think it's important to communicate to the broader teams that might not have a technical focus that the most likely outcome is ultimately going to be the wrong answer, right? We're going to be somewhere on the spectrum of outcomes, and being able to communicate the high outcome and low outcome is just as important as saying what we think the most likely outcome is. So I think at this time, I won't spend much time on the PRMS, but I think it's important to mention that this system, which of course is maintained by the SPE, is a pretty critical ingredient in making sure that uncertainty that we bake into our decision-making is, if nothing else, more consistent between project and evaluation. So using the SPE PRMS definitions, we can arrive at what we believe is a set of proved reserves or probable reserves, possible reserves, and use these categories to communicate to the broader teams what the range of outcomes is for a set of acquisition properties or development properties, and realistically center around what we think the high side and low side outcomes are. So this framework is very important as we move through the rest of the deck here to say, this is what we believe or feel conviction in as the most likely outcome. But we can also use this framework to say, well, this is what we think is the downside and upside. So I won't spend much time on the definitions themselves, but I think it's an important resource to think about as you are working to quantify reserves and production and therefore cash flows that would flow through to the financial model. This is what I call the decision stack. So I've envisioned this as sort of a pyramid, if you will, starting at the surface, or I should say subsurface, single well decisions. What are the expected returns of a specific drill well or workover project? If I look back at my career, this is my time as an asset engineer at ExxonMobil, determining which project within this field should I pursue. Is it this drill well that costs $20 million, or is it this workover that might be $1 million? What are the expected returns on that? Communicate it to management that I think this is the project to do. They'll ultimately take that in stride, compare it with other single well evaluations across the rest of the portfolio. That takes us one step further to the asset level or the program. Which projects within all that set of single well economics really meet the hurdle rate, and how should they be scheduled in the development program for an asset? And if you take one step further again, looking at the portfolio of various assets, how should you allocate capital at the corporate level between the different assets, and therefore the single well development programs and prospects within each asset? And then taking one more step forward from that is corporate level. what is ultimately the capital structure and corresponding cost of capital that you then get allocated throughout the portfolio. So this is kind of the decision stack we'll step through here in the next few slides, but wanted to frame it up this way because I think it's unique that my career, and I think a lot of careers in petroleum engineering, tend to kind of progress this way, where you start at the asset level, you slowly work yourself up through the pyramid to say, okay, I get a broader view of what's going on here. But I think what's important is to communicate this earlier in your career or while you're still in school to say, ultimately what you're striving for is an understanding of this entire pyramid at the outset. So you're not just focused on the single well, you're not just focused on a specific drill well or project, but really trying to think through how does it impact the business at the corporate level. And I think that just improves communication across the team, but also adds value to your own career because you're seeing how one small project can influence the business at large. And building on that concept a little bit, I think it's important to mention the teamwork that's required within decision making in economics. And I've kind of pitched or framed out something that I think is indicative of a lot of teams where siloed workflows can generally lead to poor decision making. So what can very commonly happen, and certainly I was guilty of it earlier in my career, is I build the asset model or the single well economic model for a well, hand that set of cash flows over to the finance team. They build the corporate model around that. Ultimately, we kind of debate the assumptions, but there's not really alignment between those assumptions and what the risk profiles are within those. And so a combination of, not strong teamwork and time pressure that's innate in almost every deal or decision-making process ultimately forces imperfect decisions. So I kind of frame this up as more of a caution or warning to say it really does take a team effort to make sure you can get to a decision that makes the most sense between these different verticals of the team, whether it's technical or finance or operations. Ultimately, it's probably beating a dead horse, but saying that it really does take an integrated team to get to the right answer. So let's start at the bottom of that triangular pyramid with single well economics. I like to think of the single well economics as sort of the building blocks or the Legos of an upstream investment portfolio or business, right? So each individual well, when developed in succession, could ultimately add value to the business in the long run because the nature of petroleum production is, of course, a declining business. We have wells that decline over time. You have cash flows that are declining over time as a result. And so you need to keep developing, whether that's through the drill bit or through future acquisitions, to continue building that company. And of course, one way to do that is drilling new wells. And so on a single well basis, if you think of a combination of successive well developments, you really are stacking the Legos on top of each other to build a larger business. So at the very smallest level, of course, looking at single well economics, there's, of course, a lot of metrics you can use to evaluate the economics of a single well. But three I've highlighted here, which generally take a lot of focus, at least in my current line of work, are an internal rate of return, IRR, discounted return on investment, DROI, and net present value, NPV. IRR, of course, doesn't really give you the context into the scale of the return or value return, but it gives you important insights into the time at which the return is made. So obviously a 20% rate of return investment will be a much faster compounding value than a 10% rate of return. But it doesn't necessarily tell you whether that 20% rate of return is going to make you $20 million or $1 million. So that's where we look at the DROI to just look at as a relative multiple of the invested capital on a time normalized basis, what is the multiple at which that value is created? And then lastly, of course, is the NPV, just a net present value, discounted at a prescribed discount rate, often 10%, but it could depend on the reserves category, what sort of discount rate you'd want to assume. But the NPV ultimately gives you a much better idea of the actual scale or magnitude of the value chain. So with these three metrics, we can start looking at comparative economics between projects, which leads me into a quick case study to discuss three competing projects. Let's say there's three potential opportunities within an asset, all of which, of course, are competing for limited capital that you have available. The first one is going to be an unconventional drill well. So imagine a high capital intensive location with a high initial oil and gas production rate, but also a high decline profile. So you get a high IP, but a high decline. Project 2 is going to be an OpEx reduction initiative. So imagine more of a moderate capital spend as a means to generate incremental savings over time on your OpEx. And then Project 3 is just a workover, whether it's installing tubing in a well to improve rates or unload the well, or it could be a saltwater disposal project, a water injection project, where it's relatively low capital, but you also have a low initial rate and low decline profile. What that looks like in terms of cash flows, I've tried to illustrate on the right here, where you see project 1, of course, with that unconventional drill well, you have a large capital spend in month 1 or year 1, however you want to think of this time period on the x-axis. But you have much higher rates that afford much higher cash flows in the interim period, followed by project 2, of course, less capital, a little bit more moderate rate with a slow decline. And then project 3, the workover, much smaller capital, but a slow and steady decline profile thereafter. I've sketched out what potential IRRs and DROIs, NPVs might look like for each of these projects. So for our drill well, where we see 17% rate of return, 1.17x DROI, and 1.5 million NPV. Project 2 is a 20% rate of return, but it has a 1.43 DROI and $1.2 million NPV10. The workover has the highest IRR at 26%, a 1.62 DROI, but only $1 million of NPV10. So thinking about these projects in isolation, you might say, look, each of these are economically viable projects and equally worthy of investing in. But if we take it one step further and we're having to compare between these three, what are the merits of each of these? So in the first case, of course, on the drill well, you'll have the highest absolute value creation. So you have 1.5 million of NPV10 versus the workover, which is only $1 million of NPV10. But of course, the capital efficiency is a little bit weaker in this particular case. A 1.17 DROI says your multiple of that 1.5 million NPV, or excuse me, that multiple of the original investment, which I think looking back here is $8 or $9 million, was much smaller than the workover, which was 1.62. Ultimately, this, if we're weighing these three investment options, the drill well is the best for absolute NPVs and just scale of the business, but it might come at much higher risk. And of course, the capital efficiency is weaker, so it might not be the ultimately best decision for an asset or development plan. Project 2 is the OpEx reduction initiative. So this is a steadier, it's more utility-like economics in terms of its decline profile. Operational durability and a lower decline exposure, of course. And it's generally best in this case based on the return profile for resilient returns that are tied to cost reduction and more immune to commodity price changes over time. And then the workover has the smallest upside in terms of NPV, but of course its very strong capital efficiency and lower execution risk might make it the most viable candidate. Ultimately, in most assets, you're working through a combination of all three of these, but I just wanted to illustrate how different cash flow profiles can be looked at, using these single economic metrics to determine how capital might be allocated if you are constrained and only are able to do one or two of these projects. Taking a step back now from single well to the asset level, I like to look at something, we commonly call the Skyline chart. So this is, if you imagine the three projects that we looked at on the last page, those would fall somewhere on this chart as different bars. I've plotted DROI versus just projects sorted from highest DROI to lowest. And generally speaking, like for like, let's say if we're just evaluating drill wells here, we can look at this chart and say, I'm going to invest in order of 1 through 9. These are the opportunities that I want to pursue and the order in which I want to pursue them. So this allows you to compare projects, at least projects of similar uncertainty and risk, to say how I want to allocate capital over time. And of course, you need to be mindful of your cost of capital for your business structure. In this case, we've highlighted about 1.25 and decided that anything that doesn't meet that hurdle is really capital destructive for our business. So we'll target investments that are above that in order to continue to grow and add value to our investment or asset. Lastly, moving up again, the triangle to corporate level economics, this is ultimately where strategic decisions are made. So again, stepping back through my career, I think through my time at Exxon and even Netherland Sewell, I was really focused on the production and the cash flow side. The reserves reports that we would put together at Netherland Sewell almost always focused entirely on the production and resulting cash flows to determine what the reserves are for a business. But one step above that is how the corporate structure is determined, which is generally a combination of equity and debt to be able to finance the business. And at this stage, we're incorporating, of course, debt, hedging, G&A expenses for the business. We're working to manage liquidity, allocate cash flow. And generally what we do with that excess cash flow is determine how to allocate it between either reinvesting in other projects within the business, paying down debt, or distributing to equity holders. So those are sort of the three outcomes that you can use your excess cash flow to reinvest or return capital to investors. Certainly, given the nature of our business being so intertwined with risk and uncertainty in petroleum economics, it's really important to make sure that we as petroleum engineers, effectively communicate the risk and uncertainty within an asset or a deal or a development project. And of course, I think it goes without saying, the assumptions that impact project risk are generally reservoir performance, given the fact that rock quality is not always homogeneous, certainly not in the lower 48, unconventional oil and gas space. Type curves that we often use in unconventional analysis, ARPS declines, those are more assumptions rather than specific guarantees or facts. And of course, small forecast errors, whether it's in your type curve or your producing well declines, can ultimately compound and materially impact long-term value. If you're off on your type curve by 20% and every well that's drilled thereafter is 20% lower than forecast, you can imagine that if you sum up all those cash flows over time, the difference between what you originally underwrote and what the ultimate outcome would be can be quite large. So we need to make sure that we communicate the assumptions that flow into our forecasting, but also communicate the uncertainties that are inherent in that and what the range of outcomes might be. Just flipping through the other assumptions here that can influence risk, development execution, one step beyond just what the geologic quality is and resulting well bores can deliver. There's also development execution issues such as drilling hazards or faulting that we have to manage through the drill bit, or determining the best well spacing and completion design to adequately and appropriately drain a reservoir. There's the commodity timing of the development project that can be influenced by commodity and service cost cycles throughout as our business ebbs and flows, as well as if we're not able to stand up a rig within the time frame that we prescribed. Of course, that ultimately results in a delayed cash flow that can just destroy value from the fact that we've committed capital to reinvest at a certain rate of return, but with pushing that investment out, it'll ultimately delay and reduce NPV as a result. And then finally, thinking through cost structure, of course, the CapEx and LOE inputs that we make as assumptions in our model directly impact investability and return outcomes. And then not entirely detached from our commodity price cycles are inflationary pressures, and overruns on the execution side, whether it's drilling or completion, or even just LOE operations, labor expenses that can create a lot of downward pressure on the return profile of a business. But looking at the list above and other risks that I haven't listed out, I think it's important to qualify that not all risk is equal. So it's important as engineers to determine which of these variables for a given development area or asset have the most impact on cash flow, have the most impact on returns, and are most capital efficient. And as a result, spend most of our time and technical efforts investigating those and the potential range of outcome, isolate the key value drivers, and make sure that we communicate that throughout our teams accordingly. One of the ways that we can do that is through various sensitivity runs. This is a slope of different outcomes, specifically on IRR. You could do this with DROI or just ROI or MPV. realistically just depicting on various sensitivities, whether it's in this case oil prices or EUR, what the potential outcomes might be. And there's other ways to illustrate this, of course, besides just a line plot. You could do tornado plots or other bar charts, etc. But in this case, I just wanted to illustrate the potential slope of outcomes for two specific projects. Here we have project A, which, as you can see, is a much shallower slope of outcomes on both oil prices and EUR sensitivity, and project B, which is steeper on both. What that might tell you is that project A is, of course, less sensitive to price. It could be a cost structure that's more fixed and less dependent on, let's say, commodity prices like high infield compression costs that would be using infield gas, and is otherwise an expense that is dependent on gas prices. It could be an asset or company that has just greater hedging in place and protects it from the upside and downside outcomes. Or there's just generally upside opportunities in that asset from cost savings initiatives. So the slope of outcomes is less dependent on volumes and more from saving on cost. As far as the shallow outcome on EUR, that could be just the nature of the asset being less dependent on, or less risk just on the reservoir side, whether it's capital projects that are just smaller in volume, capital volume, shallower declining assets, etc. And then project B, of course, is the exact opposite of that. It could be a project that has more variable costs built in. There's a lot less hedging in place, or the upside on that asset comes more from development projects that are high initial rate, which of course lends itself to more initial reservoir risk based on the fact that you have higher capital outlay to develop those wells and a steeper decline curve as a result. I want to talk through, some common early career mistakes that I know I had a tendency to make early in my career, and talk through ways that you can take a step back and ask yourself, questions that might allow you to step back from just a single well basis and think more as an investor than just an engineer. So the first will be chasing precision instead of better decisions. I think there's an easy way to sum this up with the Pareto principle, the 80-20 rule, where you really want to focus on the 20% of drivers that influence 80% of the result. And I think it's very common for early career engineers, including myself, to make models that are as accurate as possible rather than as useful as possible for the investment makers and decision-making teams. Recognizing that too much detail, obviously, notwithstanding the time that it takes to put into developing that detailed answer, can also create kind of a false confidence without actually moving or improving the outcome or business decision at large. So the real question you ask yourself here is, what variances from the base case would change my recommendation? And that goes back to sort of the slope of outcomes we looked at on the prior page, saying what variables are the most important here and would actually influence our decision, and really try to narrow down the range of outcomes on those variables. The second would be treating forecasts as answers. Forecasts, of course, the type curves that we make, they're all built on assumptions rather than actual objective truths. There's assumptions that go into that we use on pricing or spacing. And of course, all of those variables carry an interpretive nature to them. So really asking yourself what upside and downside cases should be considered and then therefore communicated to the deal teams and your broader decision-making team is a pretty important ingredient as an early career professional. The third is just ignoring capital constraints, really thinking about how the business ultimately does not have unlimited capital with which to deploy. And so you have to think about which projects make the most sense to deploy that capital and execute on. Of course, even great projects can go unfunded if capital is limited, and there's even better projects to do elsewhere in the portfolio. So this is where ranking the opportunities really matters more than just evaluating a project in isolation and saying this drill well makes the most sense because it has an X rate of return. You really need to take a step back and imagine the asset and portfolio on a broader scale. And then the last one I have listed here is just not connecting the technical work to returns. This is really thinking through, how your technical inputs ultimately drive the business's decision. Production growth alone, of course, is great, but it does not necessarily equal value creation if you're outspending cash flow to be able to do that, or destroying capital with low returning investments. So the question really is, should this capital be deployed here versus somewhere else? So I think I would just close for now, saying, how do you ultimately communicate risk and value? The first is taking a step back, ranking all the projects with which there, is an opportunity to deploy capital, determining what should get funded and when, translating the technical inputs that you've made and assumptions you made into capital outcomes to be able to include the whole team and not just the technical professionals in making that decision. And ultimately, having conviction around your range of outcomes, embracing the uncertainty that's inherent in your evaluation rather than hiding it, and making sure that the entire team is aware of the potential range of outcomes that could exist from a decision that's made. We don't want to, as good as it feels to feel convicted around a single answer, we need to recognize that there is always going to be a range of outcomes that's inherent in our business, and being able to communicate that is an effective ingredient in making a good decision as a team. So that's all I have prepared remarks for right now, but I think we have some time left, so I want to open it up to questions if there are any, and we can take the discussion from there.
Good morning, Mr. Steven. Am I allowed to speak while my camera is off?
Yeah, that's fine with me. Go ahead.
Yeah. I think I joined quite a bit late, but I was able to capture most of the highlights of what you spoke about in terms of translating the economic value of whatever technicality you have towards product or just basically revenue. One of the major questions I would like to ask is, in your experience, how do you usually convince investors or people who want to support you towards trying something new in the industry in terms of implementation, and just trying to show that this technicality that you're trying to propose might have such and such outcome, but also be cognizant of the negative side?
Yeah. No, I think that's a good question, particularly because it's difficult to communicate, complex technical concepts to investors that might not come from a technical background, and B, because what we're trying to communicate is trying something new that may or may not have the desired outcome, and getting support and investment behind it. And I think ultimately what that comes down to is being able to communicate succinctly what the ultimate plan or test will be, but two, being able to show, okay, these returns, if this works out, more than meet the investment hurdle that our corporate structure is trying to make. Meaning, if it's a somewhat risky proposition, let's say you're trying to run wireline down a hole that is a well that's already producing at a pretty good rate, right? There's risk entering that wellbore. If the returns themselves on a risk-weighted basis still meet that threshold, then communicating that is an important step towards coalescing around a decision that makes sense and being able to execute. So I think just the simplest way to think about this is, with greater risk, investors expect a greater return. And so with that in mind, being able to communicate the potential outcomes, which would hopefully be much more positive on just the, economic return basis than the status quo or the do nothing case, is very important. And I think communicating ultimately the technical concepts that you're trying to describe, translating that into cash flows and the potential range of outcomes is a really important part of that, if that answers your question.
Yeah, that makes a lot of sense. And in fact, that pinpoints exactly to what I was driving at. And I noticed one of the big assumptions that, because I don't think I started from the beginning. One of the assumptions that you mentioned that impact the project risk was the quality of the rock, which is usually heterogeneous. And in today's day and age, where we're trying to implement different models and AI at the same time, I think this is really going to be influential in going forward and try to practice some things digitally, more in a de-risk form. I guess that's what I'm trying to say.
Yeah.
Which might be able to enable us to do better on the field. So I think it's in that light that I asked the first question, trying to communicate that whatever you're going to eventually model and predict, those predictive models, and then, that would now enable people to see that, oh, this is actually possible and this is something you can work with. So
yeah, no, I think that's a very good point. And
yeah.
obviously AI and data management and analysis are very key buzzwords in the investment space, and so that can resonate pretty well. But I think what is even more important than that is being able to demonstrate how those AI initiatives or machine learning algorithms have already produced sound results in analogous fields or applications, and being able to say, because of that, we're able to de-risk the range of outcomes on our own asset, carries a lot of weight with investors or decision makers, because you're able to show that there's a track record of it having worked before. And being able to demonstrate that analogy is key, but even if there's an application that's somewhat similar, that would go a long way towards communicating your desire to enact that outcome.
Yeah, sounds good. Thank you so much, Mr. Steven.
Yeah, thank you for the question. That was a good one. Any other questions I can answer? I can also flip back through some of the earlier slides if there's...
Steven, I was wondering, how do you connect this ROI or discounted ROI with the risk factor associated throughout the business? So is it step by step you do and count it together, like we do the risk and uncertainty analysis? Or you define, like, for a certain level of risk, you need at least this much amount of ROI or discounted ROI. How do you go ahead in such a case?
Yeah, I would say, so for better or worse, right? So as engineers, we sort of think in terms of Monte Carlo, range of outcomes based on, a set range of variables for all the various inputs, porosity and water saturation and deliverability rates, et cetera. Ultimately, for the limitations for a lot of financial firms and decision makers, that needs to coalesce into a single set of cash flows, or a discrete set of cash flows, meaning you're more or less forced to develop a most likely, a high side, a low side, and that might be it, right? So being able to take a probabilistic outcome and communicate that into discrete deterministic cash flows, but communicate what went into those deterministic outcomes, is a very key ingredient to translate the technical risk into the commercial risk. And so while it would be nice to quantify, this is exactly the risk that we face in this asset, you're more or less forced, at least in a lot of companies and businesses, to communicate that in terms of a single set of outcomes, to say, all right, I believe this is the most likely, but here's how we want to iterate around that to be able to determine the range of outcomes for that investment. So I don't know if that answers your question, but ultimately as engineers, we're kind of forced to say, this is the deterministic forecast that I choose, but here's what could happen, and communicate that with your teams.
Got it. So technical uncertainty translated to economic uncertainty. How it is actually done in practice? So porosity level uncertainty or the heterogeneity level uncertainty. So it will come to at the simulation level to forecast, and then forecast will come down to the cash flow level and then translated to the economic level. But when we see the risk and the ROI, how do you connect it?
connect so I would say I pulled up the PRMS slide here again because I think it is a pretty key ingredient to how investors, or maybe where on this chart that investors tend to focus. And at least from my experience, a lot of investment decisions are made based on the most likely outcome from a set of reserves. And that's generally this upper middle quadrant here, where we recognize these reserves are commercial. We can invest behind that because we recognize that the accumulations are already discovered and they're already commercial. But they might exist in this uncertainty range of probable, meaning this is as likely as not to occur, whether it's the P50 forecast on a PDP or the 2P forecast on a development location. Probable is at least in my experience, a lot of what the investment community centers around to be able to make investment decisions. And so all of the inputs that you feed into your technical model should generally be thought of in sort of this P50 sense, recognizing that if some of those variables, if you load in a bunch of P10 variables, those can compound on each other with statistics to ultimately arrive at a much less likely outcome without even realizing it. So being mindful of the inputs that are flowing through the model, and centering around sort of a P50 outcome, which often involves using historical data to determine your commercial inputs, established well declines to determine your forecasts. That can get you a lot more comfortable with a set of cash flows that would accurately reflect the P50, through which finance and yourself can coalesce around what you think on that P50 scenario, what you think the ROI and IRR might be for an investment. But of course, you're going to set together a set of sensitivities that say, well, if my DNC is 10% higher or 10% lower, or in the case where the DNC is just more of an uncertain variable, 25% and minus 25%, thinking through the ranges of sensitivities that you want to build around that can then help you develop this, charts like this. So over here, where you can visualize the slope of outcomes to just visualize for an investment what the sensitivity is to oil prices or EURs or OPEX or CAPEX, and being able to just get comfortable based on your investment criteria that the business's thesis is built around, that an investment is an appropriate one to make, or that you've priced it accordingly in recognition of that risk. So I don't know if that answers your question exactly, but at least in my experience, we coalesce around a set of cash flows that we believe are sort of the P50, but we recognize that there's a set of sensitivities that must be made to be able to make a decision that prices in the risk that exists on these sensitivities.
Makes sense.
Thank you for the question.
Mr. Stevens, sorry again. This is Raphael. Will this slide be available anywhere?
Yes, I think we're recording the conversation, and I can provide the deck as well for sharing.
All right, sounds good. Thank you.
Any other questions for the audience? Like I said, I open to discussion on these topics, and this is, these slides are, for legal reasons, of course, this is not, the view of Kayne Anderson by any means, but just sort of insights that I've gathered over my career that I wanted to share with you all. So hopefully you found this helpful and open to discussions after the fact if you'd like. And like we said, we'll publish this for a resource for y'all.
Hello, sir. As we come to the end of today's session, I would like to express our sincere gratitude to Mr. Steven Johnson for sharing his valuable knowledge and industry insights with us. Your session has given us a clearer understanding of how economic principles drive decision making in energy sector. I would also like to thank all the participants for joining and actively engaging in today's webinar. A special thank you to the organizing team of the IIT Guwahati SPE student chapter for their efforts in making this event a success. With this, we conclude today's session. Thank you all, and we hope to see you in our future events.
Thank you all very much for joining.